Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And I hope you enjoyed the Q&A episode that I published yesterday. Just as a reminder, if you have any questions about this podcast or any other topics I've spoken about, or just a general question, obviously I can't give you specific advice, but I'd love to hear from you. Just email them to questions@investopoly.com.au. And of course, I've got a couple more questions to answer at the end of today's episode. Anyway, let's get into today's episode, which is the best super fund. So every year, well, at least for the last 3 previous years, I've written a blog and recorded a podcast about super returns, some of the things that you need to really consider when choosing an industry super fund, and then I'll wrap it all up and highlight which industry fund I think is the best if I was looking to use a industry super fund, of course. So first off, let's talk about investment returns, particularly for the last financial year. So that's the financial year ending 30 June 2024, the one that just passed us. I had a look at the top 8 industry funds and compared returns over 1, 3, 5, 7 and 10 years, just to provide a little bit more history. The theme is pretty consistent in terms of, which funds are performing well over those periods of time. And for the 24 financial year, Australian Retirement Trust comes in number 1. Now, Australian Retirement Trust used to be Q Super and Sun Super, 2 government and industry funds that merged together, so they're a pretty big industry super fund now. They returned 11% last year for the balanced option. The other 4 funds were between 9 and 9.6%. The worst performing fund was Host Plus, 7.6, worst performing out of the top 8, by the way. And Rest, Australian Super and CBus were all in the 8%. So a big difference, I guess, on a 1-year basis, but you can't pick a fund just on 1 year's returns alone. Australian Retirement Trust, ART, over a 10-year period comes in the top fund in terms of returns, 8.9%. UniSuper's takes in second place at 7.9%. And when we look at growth or high growth options, which is really where you've got between 77 and 90% of your balance invested in shares or growth assets, and they all call them different names. It can be shares plus, it can be growth, or it can be just high growth. A little bit confusing with respect to their names, but returns range between 10 and 12.5%. Again, Australian Retirement Trust, ART's, the top position there at 12.55%. And then the top 4, the remaining of the 3 out of the top 4, are in the 11% ranges. Again, that's just the last year. So if you look at 10 years, ART's the winner again. UniSuper and Hester and CBus are not too far behind ART from that perspective. So depending on how your balance is invested, you either have enjoyed pretty close to double-digit returns or you have enjoyed double-digit returns. And that's after a pretty good last financial year as well. So, balances have certainly enjoyed a clean run, but we've got to remind ourselves that that's not going to be the case every year, of course, and we've got to expect some volatility in the future. So why have some of those industry funds underperformed this year? Great question. Very difficult to answer because of lack of transparency around their investments. But every year I've written and warned investors, superannuation investors, about unlisted assets. And it's something that we've got to be really conscious of because it's a bit of a black box in terms of what these industry funds are investing in, how often they update the valuation of unlisted assets, which has been more recently than in the past, thanks to the regulator demanding them to do so. But, how reliable are these unlisted asset valuations as well? Now, the challenge is no one really knows. There's just not enough disclosure and reporting around it. And I've often argued that it needs to be greatly improved. For example, if you're a listed company, you have disclosure reporting obligations. So if something goes bad in your company, you've got to tell the stock market. And what they're aiming there is you've got complete transparency information, so the price of a stock reflects, all material information about that stock. I would argue we need to sort of have the same setup for industry super funds, that there needs to be reporting of these sorts of things. Now, the average Australian's not going to read it and not going to consume it, but the financial advice industry definitely will. They'll trawl over these reports and they'll write articles and blogs and podcasts and all those sorts of things. And for those people that are interested in choosing a appropriate super fund, they'll have access to that information and advice. advice, and the market will work out, what it likes and what it doesn't like about some super funds. Unfortunately, that's not the case at the moment. It's very opaque, and you really just can't get any sort of sense of what the portfolio looks like. All you can judge is from the disclosures that they can make at a very high level in terms of asset allocation, then past returns. But it's really, you're putting a lot of faith in that they can repeat those past returns. And some of those super funds haven't been able to do that in the last year, particularly CBUS and Hostplus stand out as pretty poor performance over the last financial year. The other concern is the conflicts of interest and the control that, whether it's direct or indirect, that political parties and unions have over industry super funds. The reality is that most of the board of directors of these trustee companies, of the trustee of the super funds, the industry super funds, almost all of them are union members, either acting as employee or employer representatives. And the number of independent directors is in the minority. Now, most of these employee and employer representative directors have very little to no knowledge and experience of running an industry super fund. So very little experience around investment markets or superannuation generally. It's not a great situation. And I guess the CFMEU, the construction union, certainly has been in the paper lately. Of course, we've all been well aware of the allegations of impropriety that have been aimed at them. And it's been highlighted more recently as a result of, the CFMEU being in the press, that CBUS, which is the leading construction industry super fund, paid the CFMEU $1.25 million in the 23 financial year. So we don't have the 24 disclosure. I imagine it's going to be more, for sponsorship services. And the other thing too, to be mindful of, is the chairman of CBUS is also the president of the Australian Labor Party. And surely that gives rise to a conflict of interest, because CBUS turned around very quickly and committed to investing $500 million in the Labor Party's National Housing Accord. The goal of super is to grow retirement savings, not advance political agendas. And I just don't think it makes sense to have, and I want this podcast to be apolitical, right? It's not a political bandwagon. It's a independence bandwagon. I strongly believe that no institution, that includes all political parties, all unions, anyone else, should have any influence over Australians' retirement savings. The superannuation industry absolutely must be free of any vested interests. And we know from the Royal Commission into financial services, we know from all the bad stories we've seen from financial planning, that vested interest is to blame in every single situation. You eliminate vested interest and you always are going to achieve better outcomes for people and obviously Australian retirees. So it's a big concern. There's not enough oversight. They're kind of marking their own homework because the unions have a lot of control over the Labor Party. The unions also have a lot of control over industry super fund. And so you've got a government in power that, as I said, kind of marking their own homework. It always concerned me with respect to industry super funds. I'm not suggesting that that's the reason why you shouldn't be there, but it's certainly something you want to be thinking about and whether you're comfortable with that sort of exposure and risk. In terms of choosing an industry super fund, more today than probably ever before, and especially if we acknowledge that superannuation laws are really confusing. I mean, they're difficult to keep on top of even as a professional, let alone if you're not in the financial services industry. That the government more recently has passed some new laws to make it easier for super funds to provide limited financial advice to members. And that might sound like a good idea on the face of it, but it sparked a lot of debate in the financial planning industry. There's certainly lower training and qualification standards, and I think that's less than ideal. But most importantly, there's a huge conflict of interest because they're a single product provider. And if we've learned anything over the last 2 or 3 decades, that we shouldn't attach a product to the advice process. So that is, if I've got something to sell you, that's bad news. If I've got nothing to sell you other than my advice, that is the best outcome, because that way you're going to get independence. Now, if I go and ring up my industry super fund and say, well, which is the best industry super fund for me? What answer do you think they're going to give me? As Warren Buffett says, never ask your barber if you need a haircut. You know what the answer is going to be. Having said that, I think industry super funds are well placed to provide basic advice. If I ring them up and say, what am my contribution caps and my limits, and should I make some non-concessional or concessional contributions this year? I think we want to make sure that super funds are able to provide us answers to some of those questions. I think it's a good idea to have some sort of advice piece, but we've got to recognize, you as the consumer needs to recognize the limitations associated with that. Firstly, they're not going to have the same training and experience as a financial advisor. And secondly, they've got a conflict of interest. Don't ask them if that's the right super fund, but certainly you can ask them questions about, how your super balance is invested and what you're contributing and those sorts of questions. Now, while we're on the topic of superannuation, you might recall back in June, episode 310, in fact, I did an episode on why I proposed the question, maybe you should invest 100% of your balance into shares, particularly if you have a long-term time horizon, knowing that shares are likely to deliver the highest return over, multi-decade or decade periods, so very long periods of time. And since people can't access their super until they're at least 60, then if you're at least 10 years away from either 60 or wanting to access super, it kind of makes sense that you would invest it in a way that's going to maximize returns between now and when you need to access super. So that's sort of invest in a high growth or growth sort of asset allocation as opposed to balanced or anything like that. So if you're interested, episode 310, go back and have a listen to that. If we're talking about super and industry super funds, it might be a good time to sort of remind yourself from that as well. Another consideration is your super balance. You see, industry super funds charge relatively high percentage-based fees. That means as your balance grows, so do your fees, of course. So there's no real economies of scale. It's important for them to use percentage-based fees because they have a lot of accounts with low values, with low balances. And so they can't have a fixed fee because that's not going to be fair to the people that might only have $5,000 in their super fund. It'll quickly get eaten away by fees. The consequence of that means, though, that the people with high balances end up sort of subsidizing the cost, those with very low balances. So therefore, I think if you've got a really high balance, and I'm really thinking probably north of $500,000, but certainly if it's over and above, say, 750 or sort of around that mark, there's no, perfect balance. Chances are that an industry super fund won't be the cheapest option for you, that a wrap platform, in fact, might be cheaper. I did a comparison between, say, someone with a, $750,000 in a really cost-effective industry fund versus into a wrap platform. And if you want to know more about wrap platforms, I've got a link in this particular blog on the website that links to another blog that I wrote a few years ago about wrap platforms to sort of explain what they are. Essentially, a wrap platform would cost you about maybe 0.5% in total fees versus a industry super fund that's sort of closer to 0.7%. So I hate to compare percentages in percentage terms, but the difference in fees is considerable. And as you increase the amount that, as your balance grows, obviously these relatively small differences in percentage in dollar terms make up a really big amount. So those with high balances, really need to be conscious that they're probably going to pay higher fees in an industry super fund environment. Conversely, those with very low balances, an industry super fund environment is a perfect place probably for you to be because it's relatively cheap. Okay, so before we get into some more questions, more Q&A and listener questions, who's the best super fund? Well, I think UniSuper, again, as I concluded last year, is the best industry super fund for 4 reasons. Firstly, its past investment returns have been consistently strong. They're not as good as ART, and I'll talk about ART in a second, Australian Retirement Trust, but they're pretty good. They're either sort of second or third or around about that mark, but they're pretty good. Secondly, its balanced and high growth investment options have the least exposure to unlisted assets. So most of their investments are in liquid, transparent, listed markets, which means that it gives you a lot of comfort over the returns they're reporting and the income they might produce and the value of those investments over time. And so its balanced option only has 14% potentially allocated to unlisted assets and high growth only 8%, which is the lowest of all those industry funds. So I like it from that perspective. It's got the lowest fees, particularly lowest percentage-based investment fees. And, fees are certain, returns are not. So that's a really important consideration. allocation. Look, probably people don't pay a lot of attention to fees when returns are 10% per annum, but in the years you can have negative returns or very low returns. Fees start to attract a greater focus, but you may as well be focused on them now. And fourth, UniSuper offers financial advice to its members. Again, not all industry funds do that. So why haven't I recommended Australian Retirement Trust, ART? Because they've produced the highest return over 10 years. Well, firstly, they have a large allocation towards unlisted assets, a substantial allocation. And, gives them, if they wanted to, the ability to manipulate returns to the extent that they can manipulate the valuation of those unlisted assets, which is a bit of a concern. And their investment fees are a lot higher than UniSuper's as well. So whilst I'm not going to get dazzled by, someone dangling a high return in front of my eyes, I need to look behind that to really assess the risk of that super fund. Now, of course, don't take this as personalised advice. It's not. It's general in nature. There's a lot of things that you want to consider when switching super, including insurance and estate planning considerations. So don't do it off the back of this podcast, but hopefully it gives you some food for thought. Okay, so as promised, let's get into some questions. I've got a couple of questions to include. Again, as a reminder, if you do have any questions, you can send them to me at questions@investopoly.com.au. So let's take a question from Andy. He writes, I have a young family where I'm the sole earner. If I die before retirement age, I'd like to make sure my super is inherited by my wife in a way that it remains invested. Currently, I'm invested in high growth options in the industry super fund, which, as we know, is invested more than 75% in shares. As stock markets can be quite volatile in any given year, I'm afraid that if I die young, and if it happens to be after a stock market drawdown, the super benefit to my wife could be a lot lower than it otherwise would have been. Ideally, I'd like to invest my super in a way where when my wife receives it, it stays invested in the stock market and isn't cashed out. How could we structure my super to get that outcome? Will having a shared self-managed super fund with my wife enable us to do that? It's a great question, Andy, and it's, I think, a valid concern because it's possible that, the stock market drops 30%, your balance drops 30%, and then you pass away and your estate, the amount that you're leaving to your wife and I don't know if you have children, but any other beneficiaries is a lot less than expected. To be able to preserve those investments, because once a person dies, a benefit payment has to be made by the super fund. And assuming that you're not yet retired, you said you're young, that benefit payment then has to come to your wife personally. And so to be able to do that, what you need is a superannuation arrangement that allows an in-specie, what they call the in-specie transfer of investments, which is another way to say an off-market transfer of investments from one account to the next. Certainly a self-managed super fund would allow you to do that. Also, a wrap platform allows you to do that as well. And so potentially if you're in either of those style arrangements, the investments can then be transferred into her name. She could then potentially transfer some of those monies back into her super account, potentially, or, depending on what she needs to do with the money and so forth. But certainly she can hold on to those investments, wait for the stock market to recover, and then divest if she wants to do that. Whether you should do that to accommodate that risk, I'm not sure. In fact, I don't think so. I think you're probably overcomplicating it. The way I would accommodate that risk is probably with more life insurance, life and total and permanent disability insurance. You said you were young, so insurance is probably going to be cost effective. Like, it's probably not going to cost you very much. And what you could do is maybe get an additional level of life insurance that was equal to, say, 30 or 40% of your current super balance. I mean, the share market could drop by more than 30 or 40%, but let's be realistic, I guess, about the risks. And so if you went and got another 30 or 40% of your balance in life cover, that's probably not going to cost you very much. You can remain with your industry super fund and you don't need to then have the hassle of, running your own investments either through a wrap platform or through a self-managed super fund. So that's probably how I would accommodate that risk, Andy. Okay, the next question is from Joel. I mean, they're all great questions. I'll be honest, when I asked for questions, I didn't know what sort of questions I was going to get. I think they're all really interesting questions. I hope you're interested in them too. Anyway, Joel writes, I'm a high income earner in my mid-30s. properties. My home is an older house on 300 square metres of land in an inner ring suburb. Can you speak to the decision-making framework between continuing to sell and upgrade your home as an investment strategy versus buying investment properties? The advantage of upgrading your home, I can see, is getting to live in a nicer house, maybe in a greater area, with greater value of capital gains that are tax-free. The advantages of an investment property I can see is the ability to negatively gear and diversify. Awesome question, Joel. Really is. Because, I'm a big fan of using your home to build wealth in that, take an investment lens, continue upgrade. You can then sort of tick off some lifestyle goals in terms of living in a nice location in maybe better accommodation, as well as enjoy that tax-free capital growth. And I've spoken about that in the podcast before. So what is the decision-making framework? Well, I would always link it to goals. So if it's not your goal or desire to live in a certain location or size of dwelling, then I wouldn't do it for the sake of it. So you mentioned that you're on 300 square metres in a inner ring suburb. Now, if that location and that size of land was satisfactory to you, that you were happy to live there for the foreseeable future, you didn't need to think about a location or size of land or school zones or anything like that, then I wouldn't be doing it. I would say, well, I'd invest in investment properties. However, if it was important, you weren't totally happy with the location or you did need to move because of school zone, then I would certainly include that in the strategy because, as I said, I think you can end up ticking both boxes, both improve your wealth and then also hit those lifestyle goals. The other consideration is the quality of the existing asset. So whilst you might say, look, the area is okay, 300 square metres of land's fine, but maybe my current dwelling is a little bit compromised in terms of quality. Well, again, maybe you would then upgrade to a better quality asset, but maybe the sort of same size and similar location. Now, you'd have to be absolutely convinced that the impairment of the asset was worth doing it. So that is, maybe it's right next door to a commercial premises that creates a lot of noise or something like that. It'd have to be really worthwhile to do it. But just link it all back to goals. Now, if you're very happy where you are, as I said, go and invest in property. You'll get the negative gearing benefits, which are really valuable. Sure, you'll pay or rack up a capital gains tax bill, but the reality is if you invest in other assets, they'll attract capital gains tax as well. It's just a consequence of building wealth. So I hope that answer helps and makes sense. And thank you so much to Joel and Andy for those two great questions. Of course, I'm going to include more questions in the future. And until next week, bye for now.